U.S. economy just hit the gas pedal, posting its fastest growth in nearly 2 years during the second quarter. But here's where it gets controversial. Is this surge a sign of genuine strength, or a fleeting moment before the storm clouds of tariffs and policy uncertainty take their toll? Let's dive in. Summary. Second quarter GDP growth was revised upward to a robust 3.8% rate, surpassing earlier estimates. Consumer spending emerged as the hero, driving this unexpected upgrade. Unemployment claims dropped by 14,000 to 218,000, signaling a tight labor market. On September 25th, Reuters reported from Washington that the U.S. economy outpaced expectations in the second quarter, fueled by strong consumer spending and business investment. However, there's a catch. Momentum may be fading as tariffs and policy uncertainty begin to weigh on growth. The Commerce Department's Thursday report highlighted the fastest growth since the third quarter of 2023, partly due to a sharp reduction in the trade deficit as import volume slowed. And this is the part most people miss. The economy's resilience isn't just about GDP numbers. Data from August showed businesses ramping up equipment demand, driven by an AI spending boom, while unemployment claims fell as companies held on to their workers. At first glance, this suggests the Federal Reserve might not need to cut interest rates further. Yet, economists blame tepid hiring on President Donald Trump's import tariffs and immigration policies, which nearly stalled job growth in the 3 months through August, prompting the Fed's recent rate cut. Christopher Rupke, chief economist at FWD Bonds, pointed out the current Fed interest rates aren't slowing the economy or hurting the labor market. If job growth is slowing, it's not the economy's fault, it's the Trump 2.0 immigration policies. This statement alone could spark heated debates. Do you agree? Let us know in the comments. The Commerce Department's Bureau of Economic Analysis revised GDP growth to 3.8% annualized, up from the previously reported 3.3%. Economists had expected no change. The government also revised national accounts data from 2020 through the first quarter of 2025, revealing a slight contraction of 0.6% in the first quarter of 2024, down from 0.5%. Growth estimates for 2024's first and fourth quarters were significantly lowered, but offset by upgrades in the second and third quarters. The economy grew 2.8% in 2024, unchanged from earlier estimates. The primary driver of last quarter's rebound was the narrowing trade deficit, which added a record 4.83 percentage points to GDP growth after subtracting 4.68 points in the first quarter. Imports had surged in the January-March quarter as businesses rushed to avoid tariffs, pushing the average tariff rate to a century high. These wild swings in imports mean the first and second quarter GDP figures don't fully reflect the economy's true health. Trade could boost GDP again in the third quarter, with the Census Bureau reporting a 16.8% drop in the goods trade deficit to $85.5 billion in August. The second quarter GDP upgrade was largely due to stronger consumer spending, now estimated at a 2.5% growth rate, up from 1.6%. Spending on services like transportation, finance, and insurance increased. Consumer spending, the economy's backbone, grew 0.6% in the first quarter, revised up from 0.5%. Business spending also shone, with intellectual property investments rising 15.0%, up from 12.8%, and equipment investment growing 8.5%, up from 7.4%. While business spending on equipment remained steady in the third quarter, its growth pace has likely slowed. Census Bureau data showed non-defense capital goods orders, excluding aircraft, rose 0.6% in August, following a 0.8% increase in July. Shipments of these core capital goods dipped 0.3% after rising 0.6% in July. Wall Street reacted negatively, with stocks falling as investors saw the data as unsupportive of further rate cuts. The dollar strengthened and U.S. Treasury yields rose. Slow growth ahead? The Fed's recent 25 basis point cut lowered its benchmark rate to 4.00% to 4.25%. Inflation revisions were minor, as businesses sold pre-tariff inventory and absorbed some costs. Inventory accumulation fell by $18.3 billion in the second quarter. Final sales to private domestic purchasers, a key economic growth indicator, grew 2.9%, up from 1.9%. Economists predict sluggish growth in the second half of 2024 due to trade policy uncertainty and mass deportations reducing the labor supply. Lydia Bassour of EY Parthenon noted, despite a moderate GDP gain in the third quarter, driven by consumer spending and AI investment, growth is expected to slow in the second half. Third quarter estimates hover around 2.5%. Profit estimates were revised downward, suggesting businesses aren't fully passing tariffs on to consumers. Economists warn that shrinking profit margins could strain the labor market. Labor Department data showed unemployment claims fell to 218,000 in late September, but Ryan Sweet of Oxford Economics cautioned, if profit margins compress, layoffs could spike. Thought-provoking question. With tariffs and immigration policies weighing on growth, is the U.S. economy truly as resilient as these numbers suggest? Share your thoughts below.